This is a fictional Amazon seller forecast for an Amazon seller who has $10,000 to invest in Amazon and is wondering, when am I going to see a return on investment? Well, for this forecast, a trademark is required. In my years of selling on Amazon and Amazon management, I found that a trademark is essential for maximized return of investment. Generic items typically don't make as much money. The entire process lasts 12 months. So, in the beginning, months one and two, it's all about product sourcing, finding your preferred manufacturer or supplier, and building your listing. You would have to budget $1,000 out of those 10,000 to build your listing, to get things such as graphics or even optimize SEO. You should plant your roots effectively. If your roots are not planted effectively, you're going to have a bad time selling. Months one and two are the most important months in this entire process. If months one and two are done with shortcuts or done very quickly, or you eliminate months one and two, you won't have an efficient listing, and therefore you won't have an efficient product that's going to bring you back a return on investment. Now, for your product launch. Your product launch is for months three and four. That's just basically the product launch. I forecast spending 1,500 US dollars in ads for months three and four each month. 1,500 month three, 1,500 in month four. The idea behind this is to DDX. You don't know exactly how Amazon customers are going to respond to your product. And to effectively manage an Amazon account, you have to respond based off of consumer demand. So, in months three and four, or maybe even month three, if you're going to advertise 1,500 US dollars and your advertising statistics are not very pleasant, they're not very appealing, then that is a huge red flag to change your listing. There's something wrong with your listing. It could be either the copy, the images, or the price. Maybe it's too expensive, or maybe the reviews, which you shouldn't have a problem with reviews, being that you have a trademark. Now we're coming back full circle. Then we're going into months five, six, seven, and eight. Now we're going to really dive into percentages because we don't know what the percentages are for months three and four since we launched. There is nothing to base it off of. You can't say 3% of your sales or whatever because you haven't had any sales. So that's why you have to DDX and see exactly where you're at. Now that you've figured out where you're at and you fix any potential problems in months three and four, for months five, six, seven, and eight, you can start with certain percentages. So you can start with a profit margin of about 8.25%. A lot of people think, well, let me start off with a 30% margin or 40% margin. This is very appealing. The problem with that is that you're thinking about profits too early. The idea behind this investment is to have an investment that lasts for years and years and years to come. This is something that's going to benefit you down the road. This is not an immediate benefit. So that's why 8.25% margin is perfect, because it's a profit. You get a return of investment. It's a small profit, but you're also allowing yourself to grow the account. You're not taking too much profit. You're putting that profit back into the business, and you're going to better that business. You're going to better PPC advertisements by keyword cycling and constant bid modifications. And it all depends on how the customers respond. So you have to analyze your PPC campaigns and analyze your advertising statistics to see exactly where you're at and where you should modify, where you should amplify, and where you should stop and completely change your strategy. So there's ample time to figure this out. And then the final leg of the percentages, months 9 through 12, are basically months 9 through 12, you basically got everything figured out. You corrected any problems, any potential problems that your account has or may have because of images, maybe your pricing or whatever it may be. You figured it out. And now you figured out exactly what your PPC strategy will be because you spent a lot of time, 4 months, basically molding and doing your PPC campaigns to the point where now it is very efficient. And now you can expand on profits a little bit. Your profit margin should be 11% for the final quarter. Your takeoff should be 10%, and your Amazon fees will always be around 45%. I've found it's 47% many times. And now here's the forecast. So as you can see, months 1 and 2, bunch of zeros. Why? Because you are sourcing. And then month 3 is when sales actually start. The first month of sales typically is not super good. It's not, you don't figure it out immediately. So that's why I predict sales to be at $2,000. And again, this is based off of a $10,000 investment, which has $5,000 in cost of goods inside that investment. So I only predict just $2,000 in sales because it's just going to be one SKU. You're not going to figure it out the first month, but you are going to advertise $1,500 here. $1,500 the first month, $1,500 the second month as well. And the second month, you're going to start to figure things out a little bit more. You're going to really see exactly what your main keywords are, where your clients are based out of, what do they search for, and that's going to amplify your sales a little bit. It's a pretty rapid improvement from month 3 to month 5. And as you can see, the margins are actually very unfavorable, but they're not as bad as one may think. So the month 1, you have already invested $10,000, and in month 3, you're gonna have another hit of negative $1,900, and in month 4, another negative hit, negative 600, and in month 5, it all starts to be positive. And so now you're going to calculate until the end of the year. And in the end of the year, you're going to have you should have like an 11% margin, but here it says it's about 9%, maybe 10%, but that's pretty close. That's pretty spot on. Remember, this is a fictional situation. It's all going to change depending on the product, depending on the brand, and depending on things that you use. If you use a third party advertising tool like social media, this is going to amplify your sales as well. So this is completely fictional. It's just so you can understand where your margin should be at. So I'm putting 9% here for month 9, but it could be more. In fact, I'm probably willing to bet that it's going to be more. But for the year, I do have around a 4% margin for your total sales. Now, this means that a lot of your fees, a lot of your investment has been paid already. Your cost of goods has been paid because it's already here, cost of goods. And you probably have to reorder your products because as you can see here, your cost of goods is actually $23,000. So there's a certain point where you're probably going to reorder in month 6 or maybe month 9 so you can keep on with this business. And that's the idea. And I'm going to briefly show here. These are the main kind of highlights of the investment. $3,000 upfront cost for the first 2 months of ad spend, $500 per year trademark cost, and the $200 flat rate for Amazon Vine. Amazon Vine is essential for this growth. And yeah, the idea behind this investment for this fictional seller is to have a reliable business that they can simply restock and just make money on. So let's say that these numbers are just 100% accurate. There's nothing, there's no estimation. And let's say you finish month 9, 10, 11, and 12 with $900 in profit every single month. So the idea here is month 13 and beyond, you're not starting at negative 1,900. You're starting at positive 900. And you're repeating this process for year 2. And year 2, it's a lot easier because now you have sales momentum, you have reviews, and you have a much better listing that is capable of getting you way more than $900 per month. So essentially, yes, this investment, this $10,000 investment, does not bring you much the first year. But the second year, it can be very, very fruitful.